What's up guys? So I've been getting a lot of requests to cover this topic and I'm going to give you guys what you want. So without further ado, today we're going to go through stock market basics for beginners, guys. The basic knowledge you need to know to get started in the stock market. Hi guys, it's Warren Gosling here, back again with simple, actionable financial literacy tips. If you find today's topic useful, do 3 things for me: like it, share it, subscribe. Also, head over to my Instagram. I'm at Warren Gosling. That's at Warren Gosling. I'm always happy and interested to speak to you guys. So today I'm going to take you through some key stock market basics for beginners. What are stocks, how they work, why they're worth investing, and where you can buy them. If there's anything else you want info on, just let me know in the comment section below and I'll be happy to answer your questions. So let's start, guys. First of all, with the basics, what is a share? A share, as the name suggests, is a unit of ownership in a company. And when you own part of the company, it titles you to a share, there's that word again, of the profit that it makes should it choose to distribute them. Now, shares are usually for public listed companies, and a public listed company is one who makes its shares publicly available for purchase. So for example, you might have heard the term floating on a stock exchange, and what that is an initial public offering or an IPO, whereby the company makes its shares available for the public to buy, and in the process it's raising money so that it can go about whatever its business objectives are, whether it's investing in a new expansion project in another country or a new line of products, lots of different things. And the great news is, guys, is that there's nothing stopping you or me from owning parts of these companies, guys. Ownership is where the wealth is at, guys. So how do they work? Well, shares can also give you voting rights depending on their class, whether they're ordinary shares, preference shares, etc., on certain decisions that the company needs to make. They're not just about income, guys. So for example, Mark Zuckerberg will have shares in Facebook, which give him control and voting powers along with the other shareholders when it comes to the decisions that Facebook makes about its strategy, its direction of travel, etc. If he sold all of his shares, his voting rights and his decision-making authority within the company would disappear overnight because he doesn't own a stake in the company anymore. But it's worth noting, guys, that you need to own a lot of shares in a public listed company, usually millions of pounds worth, to get that level of control in a company. Most people own shares for the financial benefits rather than the ability to control and run a company. So why are stocks and shares worth investing in? Now, if you're looking to make money from shares, there's a few things that you need to know about how this aspect of shares works. So there are 2 key ways in which people build wealth from shares. The first is the growth in the value of a share over time, and the second are the dividends that it pays out. I like to use a property analogy when it comes to describing shares because I myself invest in property, if you've watched some other videos on my channel, and I understand it, as most people do, because we all live in houses. So owning a share is a lot like owning a house. When you own a house, it can go up or down in value, which of course impacts your net worth. The rise and fall in the value of a house is called a capital gain or a capital loss. You might have heard this term before. And shares will rise and fall in much the same way as a house does. Secondly, when you own an investment property, you also get money from the rental income. And the equivalent of the rental income with a share is a dividend income. So you have 2 forms of wealth building when it comes to shares, as I said, capital gains and dividend income. Now, not all shares grow in value, guys. They can decline and they can fall. And if a company is not making profits that year, it's not likely to pay out a dividend. So returns are not guaranteed, guys. But generally speaking, the stock market rises over time. So when we look at the official data in the UK for the FTSE 100, that's the indices of the biggest 100 companies in the UK, the data shows that the FTSE 100 has grown by just under 100% over the last 10 years and 240% over the last 20 years. So if you would have invested £10,000 in a simple index tracker 10 years ago, did absolutely nothing, guys, absolutely nothing, just sat on it, you would have £20,000 today by doing absolutely nothing because the stock market rises over time. So now I want to take you through some basic terms that you should know when it comes to stocks and shares. First is ordinary shares. We touched on these earlier on, guys. These are shares that give owners a right to dividends and voting rights within the company. Second is preference shares. These don't have voting rights. However, their advantage over ordinary shares is that preference shareholders, as the name suggests, are first in line when it comes to dividend payments. They get preference on those payments. Next up is the FTSE 100. This is the list of the 100 biggest companies by market capitalization in the UK. Now, market capitalization is the share price multiplied by the number of shares in circulation. So if I had my own company, Warren Gosling Limited, and I had shares worth £10 each, and I had 1 million of those shares, my market capitalization of my company would be £10 million, okay? That's the market capitalization. Next is the FTSE 250. So as the FTSE 100 is the 100 biggest companies, the FTSE 250 is the 250 biggest companies in the UK. And just for your information, larger market capitalization companies, so the largest companies, they tend to be more stable and more profitable. So therefore they're usually more likely to pay out dividends regularly. Earnings, guys, this is the profit that a company makes in a year. Next up is earnings per share, which is the total profit divided by the number of shares in circulation. Earnings are important because they directly impact the share price and the share volume. So if a company is doing well and it's healthy and on track to make large profits, that's happy days, share prices and the amount of shares being traded usually goes up. And the reverse is true. When a company gives, say, a profit warning and it's having a bad year, the share price and the volume of shares tend to drop in line with that. You also have the price to earnings ratio. So this is a ratio that investors make a big deal of, and it's the share price divided by the earnings per share. So if a share price is, say, £10 and its earnings per share is £2, then its earnings per share ratio is 5. Okay, why is this useful? It's just the number 5. Because you can use it to compare similar companies in similar industries. So for example, you could compare the price to earnings ratio of Zara to Boohoo to Primark to Uniqlo. Don't sleep on Uniqlo, guys, their stuff is lit. And a high PE or price to earnings ratio means that the company is expected to grow in the future. So those are some really basic introductory terms for you guys. One thing that you need to know is that share ownership is an administrative nightmare, guys. There's a lot of paperwork. And traditional share ownership comes in the form of share certificates, which is paper proof that you own a share in a company that you've invested in. You also have dividend vouchers, which are vouchers every time you get paid a dividend. You have minutes of meetings. So if you've ever worked in an office like I have and you've had to take minutes, you know what they're like. They're a ball ache to do and a ball ache to read, guys. So you get those. You also get meetings, notices, resolutions, and everything in between, guys. Just a lot of paperwork. And if you're like me and paperwork stresses you out, you want to avoid this, guys. So how can you do this? Well, the question is whether you want to hold shares directly or via a fund. Now, even if you're not investing savvy and you're completely new to all of this, you would have heard of the term, or you're likely to have heard of the term fund before. I myself invest 100% through funds, and come back next week because I'm going to do a whole video on this, how to invest in funds and all of the benefits that come with that. So that's today's video, guys. It's an introduction to how to invest in stocks and shares in some basic terms. Come back next week when I'm going to go into it in more detail and give you guides on how to get started. If you found today's topic useful, please consider subscribing and sharing, and I'll see you guys next week.